So, we're recording a video today because we've had a lot of activity in the markets as a result of the COVID-19 outbreak. We've been keeping clients informed through updates from CAS, and we thought we would speak to you and get from the horse's mouth, so to speak, what's actually happening. We all know what's going on in terms of the health impacts, and everybody's on alert and washing your hands and singing happy birthday, etc. What's going on in the markets?
So markets have, I think, suddenly woken up to the fact that they almost certainly have got a proper pandemic in place, although it wasn't announced earlier. And then markets have to scramble around for likely outcomes. And markets hate uncertainty. Uncertainty is what you can't price in. If you know what the risks are, you can price it into the relative value of shares or a block of shares. But we haven't had a pandemic in this country since 1968-69, and in fact there's only been 3 in the 100 years, well actually just over 100 years. You've got one in 1918, you've got one in 1957, you've got and then the last one 1968-69, and now that's called 68-69 because it starts in the spring and it reappears in the following winter. So I've been around for 2 of those. One, I was just born in 57, and obviously I was 10, 11 when the next one occurs in 68, 69, but I've got to say I can't remember it. Which means actually there's not many people around today living and working in the financial sector that can actually remember a pandemic. So you're then forced to look back at statistics of what happened in previous pandemics. So if we look at what people's main concerns are with regard to COVID-19, it's that it's affecting people, it's infecting people very, very quickly, and it's killing a certain number of people. I talked to a long-standing doctor friend of mine, and he said it's a remarkably clever virus because it doesn't wipe out too many of its hosts, which maximizes its chance of being passed on, but it's very, very good at getting passed on. So look back to probably the worst pandemic we had was 1918, and then I'll try and put that into context with what we're seeing or what the data is out on COVID-19 so far. So you go back to 1918, it's a nasty outbreak of influenza. It has a devastating effect in this country. The infection rate is about 25% of the population. So that's quite a lot of people getting the illness. But the mortality rate is actually quite high, over 2%, around 2.5%. And unlike modern influenza viruses, this one takes out people across the demographic. So an age group that's particularly badly affected in 1918 is 25 to 35-year-olds. Now, we're not sure why that is, but if you look around 1918, there's a lot of young men coming back from fighting the war, and they probably weren't in the best of physical conditions. And this is the thing with influenza viruses, and COVID-19 is no different in that regard. They will attack the weak. Subsequent viruses, 57, 68, 69, tended to get the very young and the very old. The stats for COVID-19 so far, as much as we can understand them, are that it seems that the infection rate is running a lot higher than the 25% from the 1918 virus. So it's more like the 57, 68 type virus, but its fatality rate is around 1%. Not as high as 1918, but still high nonetheless. So the worry the market has, and the reason you've got the sell-off, is because if people start dying or they become infected, they can't work. If they can't work, they're not economically productive. So if you then model a worst case scenario and a best case scenario, you're looking at something like the worst quarter being affected of something around 2 to 3% best case scenario, downward movement in activity compared to the previous quarter, with a 5 or 6% effect overall on GDP for that quarter. in the worst case scenario, you're looking at a 20% effect on the quarter. This is with a rapid spread of COVID-19 throughout the UK, and then an effect of 5-6% on annualised GDP. So that would be devastating, and you don't have to be a financial analyst to work out the effects that will have on the earnings of lots of UK companies.
So what's Courtiers' stance on it with regards to the Courtiers funds? Obviously this is a worldwide economic impact. Surely it's going to be a case of how we minimise any impact it has on the Courtiers funds and our clients' portfolios. So what approach are we taking, and is that shifting regularly, or is it something that you can plan out, say, over the course of this week, or have you got to go on a day-by-day basis?
So far, going into the crisis, which you could look at the market starting to correct to COVID-19 around about 19th, 20th of February. So far, as you would expect, our cautious multi-asset fund has been more defensive than our balanced multi-asset fund, which has been more defensive than our growth fund. But growth has been quite defensive this time round, and the reason all three of the funds have been defensive is because something we call convexity, and that's where we're using options within the portfolio to cushion the effects. So as the market falls, our exposure, not our return, we go down, but not by as much, but our exposure starts to come off. That's the effect of options. So as the market falls away further, our rate of descent slows because we're not as exposed as other funds. So far, so good. I'm not saying it's a good thing to happen, but we all know that if you're going to hold real assets, and over a period of time you will get wobbles, and this is a latest wobble. It's caused a lot of issues on the volatility because the VIX, the measure of volatility in the market, has shot up to its highest level since 2011 when you had the downgrading of US debt. So short term, the funds have done what we hoped they would do, and we were well protected going into this. I'm not going to say that we predicted it. It's just that we were able to buy protection cheap through the early part of February. So we took it, and it's had a good effect so far.
If exposure's been coming off, what are the plans to increase it again?
Well, right now, we're holding lots of cash through either cash or T-bills. So we're in a really nice position if we feel the market sells off enough to be worth buying. And I think the interesting thing with this type of outcome, or this type of threat to the market, is that it passes. The last three pandemics passed. They generally passed over 1.5 quarters, and then you're out the other side. The infection rate drops off and things go back to normal. Businesses that get badly hit are service industries. Restaurants, if someone doesn't eat in March, they can't go and back buy their March meal in June. Whereas if it's delaying a car purchase, the car purchase can follow on subsequently. So service industries tend to get hit a little bit more. Events industries get hit a bit more. But the normal sort of shape for a recovery in markets along with the economy is a V shape. In other words, you get a rapid decline in activity followed by a rapid appreciation.
Have we seen any of that appreciation at the beginning of this week as markets opened after the weekend?
So the market's responding positively just for a little bit on the basis of the announcements made by the Bank of Japan with regard providing monetary support to markets to make sure they stay liquid. But as we're beginning to find out, and I covered this in the December seminars, trying to generate extra growth in an economy through monetary policy is like pushing on a string. You can use monetary policy to pull inflation down, but it won't push the economy back up. When you've got a genuine external shock, like a virus, yes, it's better for monetary policy to be loose, but it is not going to save asset prices. These are real hits to real earnings, and there's not much that the central banks can do to protect businesses in that regard. So nobody should expect monetary policy to be the white horse charger coming over the hill, the cavalry coming in to save the day, because that's not going to happen.
One message to our clients to conclude, and then we'll see how the course of the week turns out.
So as best we can, we're on top of it. And I'm not going to say we're completely on top of it, because anyone who works in financial markets knows if you say you're completely on top of anything, you're lying, because there's so many unknowns out there. So you have to be careful, and you have to try and ensure that you're covered off all eventualities. So far, clients have lost money, but they've lost as much money as if they were fully exposed. And even in the growth fund, which is normally 100% invested in equities, has done a lot better than the market last week at least. It leaves us with reduced equity exposure ongoing and lots of cash. So our challenge is to, when we go back into the market, we won't rush back in. I think in the end, the investors in the cautious and balanced funds are more risk averse than those in the growth fund. And I think our policy will be to dip our toe in the water and rebuild that exposure gradually when opportunities come. For growth fund, which was sort of having its equity exposure down as low as 70% at the end of last week, which is pretty much unheard of for a fund that's meant to be taking risk, I think you'll see us push that back up a bit quicker, because investors in that fund are expecting us to be risk takers. In cautious fund, the investors are expecting us to protect them. As it is, so far, relative to market, we've protected all of our multi-asset funds and all of our investors. And that will be the thing that's most on our minds going forward.
Gary, thank you very much for the insight. Ladies and gentlemen, we hope that offers you some comfort and a little bit more information about how we're operating inside at Courtiers, and we'll look forward to keeping you up to date. Thank you.